This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Private Foundations Part 6, Investments. This is Professor Russell James. The next type of prohibited transactions is excess business holdings, where the private foundation, combined with insiders, holds too large of a share of a business entity. Prior to the legislation preventing excess business holdings, an owner could transfer his or her business into the private foundation, take a tax deduction for the transfer, and still continue to control the business precisely as before with no functional changes. This level of control created a number of opportunities for abuse. The problems with excessive business holdings come because the donor receives a tax deduction but continues to control the business. This control means that the donor can decide if any profit is distributed to the foundation, which was particularly important under previous legislation where charitable distributions were based upon income rather than assets. Further, the donor, as controller of the business, would continue to control his own personal compensation as well as all other employees. A donor could thus transfer a business into a foundation, take a large tax deduction, and then extract the value out of the business through salaries paid to the donor and the donor's family members as employees of the business. This payment of salary, or for example, sweetheart deals benefiting others in exchange for reciprocal treatment in the donor's other non-charitably owned operations, could be used to cause the company to incur losses, reducing the value of the company and thus reducing the foundation's required charitable grants based on the company's value. The various schemes for taking a large deduction at transfer and then subtly extracting the value from the company without benefiting the private foundation are nearly limitless, but all are predicated upon the donor being able to control the underlying business entity. Thus, the tax code was changed to eliminate the use of private foundations as a means to control an operating business. A private foundation is allowed to own up to 2% of a company, regardless of the ownership interests of other insiders. Thus, a private foundation could own 2% of a corporation that was otherwise entirely owned by the founding donor. A private foundation may not own more than 2% of a business entity if the foundation and all insiders combined own more than 20% of a business entity. Ownership can refer to voting stock in a corporation, beneficial interest in a trust, or profit interest in a partnership. Thus, for example, a private foundation may own 100% of non-voting shares in a corporation, where it and all disqualified persons combined own fewer than 20% of the shares. This permitted ownership percentage will increase to 35% when the foundation can demonstrate that an unrelated person or, quote, cohesive group of third parties does in fact exercise control over the business. In this case, the risk of abuse is likely reduced by the influence of an outside controlling person or group. An exception to the prohibition against private foundations controlling a business is allowed when the business entity is engaged in an activity directly related to the private foundation's charitable purposes and not simply earning profits for the foundation's use. Thus, a private foundation could have full control of a school or hospital and thereby further its charitable purposes in education or healthcare. Other allowed businesses include thrift shops selling donated items, a business operated by volunteers, or a business primarily for the convenience of the employees or customers of its charitable business, such as a hospital gift shop or museum cafeteria. Additionally, a private foundation is allowed to have full control of a passive business entity that merely collects payments from assets, such as dividends from stock holdings, interest from investments, royalties from intellectual property, or rent from real estate. So long as this type of income constitutes at least 95% of the business entity's gross income, full ownership of the entity is allowed. Similar to the rules for unrelated business income, borrowing money to purchase real estate will cause such investments to no longer be passive. The private foundation, finding itself in the circumstance of owning excess interest in a business, must sell or transfer those interests. This sale must occur within 90 days if the foundation acquired the business interests by purchase, or within 5 years if the foundation receives the business interest by gift. This 5-year limitation allows time for a business owner to transfer all or part of his or her business to his or her private foundation prior to a sale, thus avoiding the capital gains tax that would otherwise be due at sale, and still have sufficient time to market and sell the asset, even in a difficult market. Indeed, if the 5 years is not sufficient to achieve an appropriate sale, the foundation may go through a procedure to request an extension of the time from the IRS, allowing for up to 5 additional years. As with other violations, a private foundation having excess business holding is subject to tax penalties. The foundation must pay a tax of 10% of any excess holdings, based upon the highest excess business holdings occurring during the tax year. If the excess business holdings are not removed from the foundation within 90 days of the IRS notice of the violation, an additional 200% penalty may be imposed. In order to preserve the charitable function of the private foundation, the tax code prohibits the foundation from investing in jeopardizing, that is, excessively risky, investments. Without this restriction, there is a risk that the private foundation's assets could be squandered, thus eliminating any further charitable benefit. In such a case, the taxpayer would have received a large charitable tax deduction, but with no resulting charitable activity. Issuing charitable tax deductions in return for little or no charitable activity violates charitable tax policy principles, and consequently, such risky investments are prohibited. There is no black and white rule to determine what a jeopardizing investment is. Instead, it occurs when the manager, quote, fails to exercise ordinary business care and prudence. Although a particular investment may be highly risky, it will be considered in the context of the entire portfolio. For example, the purchase of 60-day out-of-the-money options could be a reasonable part of a hedging strategy taken in the context of other asset holdings, but would clearly be a jeopardizing investment if such options constituted the foundation's entire investment portfolio. Because of the potential for excessive risk, the IRS will pay particular attention to investments in options, margin trading, short selling, commodity futures, and oil and gas interests. Nevertheless, each of these may be a perfectly appropriate investment in the context of the risk profile of the overall investment portfolio. Because the purpose of the jeopardizing investment rule is to ensure that charitable activity will ultimately occur rather than the assets being squandered, the rule will not apply to high-risk investments that are primarily intended to advance charitable goals. Thus, investments in college loans for needy students or low-income housing may indeed be highly risky, but will not constitute jeopardizing investments. In this case, even if the foundation loses its investment, the funds would still have been used to advance charitable purposes, and so the underlying tax policy goals would not have been violated. As a penalty for making a jeopardizing investment, the foundation must pay a tax of 10% of the amount invested in the jeopardizing investment. Because the foundation manager is directly responsible for managing the foundation's assets, he or she will also be charged a penalty of 5% of the amount invested, up to a $10,000 penalty if he or she willingly and knowingly participated in making the investment without any reasonable cause for doing so. As with other violations, an additional tax applies if the violation is not corrected within 90 days of the IRS notice of violation. If the foundation has not divested itself of the jeopardizing investment within this time, the foundation is subject to another tax of 25% of the amount invested in the jeopardizing investment, and the manager must pay an additional 5% of the amount invested, up to an additional $20,000 penalty. The final way in which private foundation rules attempt to protect charitable purposes is to prohibit and penalize non-charitable grants from the foundation. These non-charitable grants are referred to as taxable expenditures. Any grant made by the foundation that does not qualify as an appropriate charitable grant is a prohibited taxable expenditure. This is not a problem for typical grants made to public charities. However, prior to the current law, some private foundations were being used to further political campaigns, which is not a charitable purpose. Thus, the use of funds for campaigning and lobbying are now prohibited as taxable expenditures. Nonpartisan research is allowed, but there is careful oversight of such activities. For example, support of voter registration drives is not allowed if such drives are limited to specific geographical regions, as this may advantage one party or candidate. Grants to individuals are not charitable gifts because an individual is not a charity. However, in certain cases, a private foundation may fund a grant to individuals for travel, study, or similar purposes. This may be done only with advanced approval of the granting procedures by the IRS. In seeking such approval, the foundation must show that the grant is 1. A scholarship to a nonprofit educational institution, 2. A prize made primarily in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievement. Note that these awards may be made without prior approval by the IRS if there are no restrictions on or expectations regarding the use of the prize money. Or 3, the purpose of the grant is to achieve a specific objective, produce a report or other similar product, or improve or enhance a literary, artistic, musical, scientific, teaching, or other similar capacity, skill, or talent of the grantee. In addition to grants for travel, study, or similar purposes, the foundation may also make grants to impoverished individuals or those who experience catastrophic medical expenses or property loss. These poverty relief or catastrophe grants do not require advanced approval from the IRS. Grants made to most charitable entities other than public charities, for example, private foundations, labor unions, trade associations, fraternal orders, veterans groups, Type 3 non-functionally integrated supporting organizations, or other supporting organizations controlled by a disqualified person, are taxable expenditures. The exception to this rule is that if the private foundation exercises, quote, expenditure responsibility on grants made to such organizations, then the grant is permitted. Expenditure responsibility requires a variety of tasks, including a written agreement of the specific charitable tasks the entity will accomplish, segregation of funds, regular reports from the recipient, and special reports to the IRS. If a private foundation makes grants that do not qualify as appropriate charitable grants, it will be penalized initially by a 20% tax on the amount of the taxable expenditure. The foundation manager is subject to a 5% tax up to a $10,000 maximum. If there was no reasonable cause to believe the expenditure would be appropriate, the foundation must recover the expenditure, or where full recovery is not possible, the foundation must recover as much as possible and take any corrective action directed by the IRS within 90 days of the IRS notice of the violation, or the foundation will receive an additional penalty of 100% of the taxable expenditure. Absent such timely correction, the foundation manager may also be penalized another 50% penalty up to $20,000. This has been Private Foundations Part 6, Investments. Join us next time for Private Foundations Part 7, Private Foundations versus Donor Advised Funds.